All right, well, let's get it going now. So we've got a great panel. That was a terrific panel talking about debt structures and credit. And it's a tough act to follow. I'm glad to have this opportunity. I've got some great people here on the panel with me. I've got Ron Harvey, thank you. Sitting right next to me, he's the Executive Chairman and Chief Investment Officer, co-founder of NewOak. We got Russell Deakin on screen, a Managing Director of Aceana Group, a family office that invests in this area heavily. So looking forward to his comments. And then we have Michael Forstl on the left-hand side, Forstl, right?
Yep, that's it.
Not Forster, Forstl. Managing Director and Head Distribution at Exos. Fintech continues to evolve, I guess is the right word. I mean, it's been pretty dramatic what's happened over the last 10 years in Fintech. And I don't see any slowdown right now. I mean, you would think that, we would have reached a plateau and things be slowing down. Yet I see more innovation and more things happening in this area than a lot of other areas. So I'm looking forward to this conversation. My name's Mark Heil. I'll be moderating this session. I've recently joined Pickwick Capital Partners as Managing Director. Pickwick is a FINRA registered advisor to middle market companies. We also do capital raising for funds. I'm going to just do a quick disclosure to cover our panel here so we're all safe. Information presented here is for educational purposes only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. To the extent I offer an opinion or any of our panelists offers opinions, it may or may not be the opinion of their firm. So there we go. For the next hour, we're going to have a great discussion. I invite everybody here to join in. If you have a question, please don't be shy. Jump right into the conversation. I would love that. It usually adds a lot to it. The only thing I'd ask is that you keep your questions to the point. Some people like to give speeches before asking a question. We need background or detail. We're not shy about asking for it. So with that, Russell, I'm going to ask you to lead off in terms of providing the introduction. Could you tell us a little bit about yourself, your family office, and what you look for?
Happy to do so. Nice to see some familiar friends on the video and new friends as well. Sorry that you guys couldn't be here last week. We had a great event with Marty and the team here in Miami, but for Art Basel. So hopefully next time. It
was wonderful. Yes,
it really was a good event. So I'm a family office, and I think all family office, as the saying goes, if you know one family office, you know one family office. So it depends on the background, and so I'll give you a little bit of my background, just in terms of operating businesses, which also reflects on what we're going to do and looking for alpha. So we have two operating businesses. We're a British Brazilian family office. Our operating business is real estate developer in Brazil, and also we have productive farmland. We have farms that produce rice and cattle. So a very nice counterbalance and counter recession proof versus the ups and downs of the real estate cycle. But perhaps most importantly, for this panel, I was a partner of Latin America's oldest venture capital private equity firm, starting in 2001, and we had tech funds, fintech funds. So I've been doing quite a lot of investing in fintech and technology a bit more broadly since 2001, first through a fund management, and then really 2006, I invested in my first fund as an individual for our family in the US, wanted to diversify. And today we invest in funds, we do co-investments, direct investments. We also do some, obviously for this panel, some blockchain, some crypto, and some tokens that we can get into a little bit more. So to us, that's an alpha seeking strategy. And obviously, as we'll get into more detail, the detail is the important part. And think about how much you invest of your portfolio in perhaps it's more volatile, more alpha seeking strategies going forward.
Sounds great. Ron, would you do us the favor and introduce yourself and let everybody know who you are?
Sure. Thanks so much. I started in engineering, then became a financial engineer, and that's been since 1994 onward. And for me, technology and finance is an ever-evolving field, and that's exactly why I got into finance, because there was a tech involved, and the finance part is really expertise in what you do. So I spent my entire career to differentiate myself whether I was working at BlackRock or I then started NewOak, is how do I leverage technology to be able to do good finance? Now, there are people who just built infrastructure, and so there's an element of that. And the way I look at finance is essentially it's got a very strong component, GRC, governance, risk, and compliance. And if you can't really efficiently execute that, you got a problem. So your expenses go up and you cannot do. Client acquisition is a second issue. And that's why you saw during the credit crisis, essentially a lot of the banks around the world, all they did was just throw money at structured products because they didn't have the infrastructure to do it themselves. We at BlackRock had built it. I had brought it from State Street. And then the next step for me was how do I now turn that into a non-structured product? Because once something gets really a bad name, and that's what happened during the credit crisis, we had a lot of people, managing a CMBS portfolio but not servicing it properly, or the collateral was acquired without proper due diligence. All of that stuff gave us opportunity to start NewOak. NewOak is really my family office because I put everything I had into it, and that's and it started in 2008. Larry told me that I'm the smartest guy or I'm the dumbest guy to give up, and that still hasn't been answered yet. So the reason is I'm long. I'm very long. The reason I'm long is because you can't time this. When you're trying to get 10x, if you cannot get 10x, don't give up the 4x, because if you cash it in your portfolio, you're only going to get 1x. So as far as I'm concerned, because you're building technology together and you're going to have an advantage, the question is, when do you actually monetize that advantage? Depends on the marketplace. If you look at Amazon, Amazon was a technology company. It took them 20 years to get to profitability, but they kept on putting money at it. And that's what I'm doing right now, putting a lot of money in embedded finance, and I'd like to become Larry of finance.
So he may not know whether he's the smartest or the dumbest guy in the room, but he's certainly the happiest. So
no, I'm very happy. My wife says I'm happy, but lots of risk.
Michael, why don't you take a minute and introduce yourself?
Thank you, Mark. I'm Michael Forstl. I'm currently with Exos Financial. I have a background more in TriFi, traditional finance on the municipal side. So we had some discussions. I know Suzanne and Brian had mentioned multifamily housing, and I think Marty was talking about it. I worked for Security Pacific Merchant Bank for years. If those people that have the same tenure as me, David Lovejoy ran our merchant bank here in New York. We had the largest tender option bond program for multifamily housing finance. So very familiar with that space. Then went to Nuveen Investments. I spent 20 years there. First when Nuveen was really a municipal investment bank prior to the TIA acquisition. Now they're a totally different firm. Most recently, and this is how I got to know Russell, is I worked for a gentleman, Mark Yusko, who ran the endowment at UNC Chapel Hill, and before that at Notre Dame with Scott Malpaz. And I helped build out his digital asset business. So we had a series of digital asset venture funds where we invested primarily in the eco-structure around distributed ledger technology. We did also invest in liquid cryptocurrencies, but been involved with quite a few individual company acquisitions through the fund. And we also made available those opportunities in a bespoke SPV program. So one of those companies was Exos Financial, and JJ and I just had a quick discussion. So notwithstanding the history of Brady Dugan, who's our founder in Switzerland, Exos was founded and is founded by Brady Dugan. He's not one of the only founders. There's quite a few, but we're a next-gen investment bank. We focus specifically on Fintech. I have a sustainable innovation platform, which encompasses a lot of the newer technologies. COP28 just took place in Saudi Arabia. We're very involved in that.
UAE.
The U.S., excuse me, the U.S. Yes, Dubai. Sorry about that.
Saudi Arabia tried to influence it, but
right. Although NEOM is a big co-investor with us in quite a few of our opportunities.
Absolutely.
You're exactly right. Yes. AI, machine learning, big data, predictive analytics, and blockchain are something that I've been involved with specific to fintech. So I can talk about specific use cases, some that have been successful and some that have not been successful. So that's the value I can bring to this
That
discussion.
sounds really terrific. And I think that's what the audience is looking for. And you brought up AI and it's almost like a new religion. So can I get an AI from the room? So while we're on that topic, just, blockchain and AI have certainly been talked a lot. Tell me where they are today and where you see them being like 5 years from now.
Sure. Well, actually, we had named a vertical at Morgan Creek, and I just left there a year ago. So it was really blockchain intelligence. And that's really the intersection between distributed ledger technology and AI. And just blockchain is so thin. You talk about fintech, it's a pretty thin vertical. And then when you're selling just blockchain, that becomes even more narrow. And there's a lot of intersections and interplay between the two. And there's a lot of companies that started with the value proposition is that I'm going to leverage blockchain to drive this new business model. The successful fintech startups that I've seen have been ones that have been disrupting an area that has been ripe for disruption, and it doesn't necessarily have to be just blockchain or just AI and machine learning. It can be a combination. And an example thereof, one of those companies that are one of the successful companies is a company called Figure Technologies. Mike Cagney is the founder of Figure Technologies. He's been disrupting the home equity loan market. So they're a warehouse lender. We were talking about lending on the last panel.
Yeah, Sean stepped out of the room, I think.
Oh, okay. And he also founded SoFi before that, where he disrupted the student loan refinancing market. And what he's doing is he's using AI. His whole value proposition is 5 and 5. I can approve an investor, a borrower in 5 minutes, and I can close him in 5 days. Now, how does he do that? Well, what he's doing is he's getting your credit scores by sifting through the cloud using AI and creating FICO scores on his own internal program so that he can get a pretty good identification of your profile. And everything now that we're doing via obviously Apple Pay or any of the CFI programs that we're working that go into DeFi is all public knowledge. So that can be readily accessible if you have those algorithms that can do that. So he can very quickly identify, okay, you're pretty good credit. I'm going to get you in the underwriting pipeline, and I'll be able to close you in 5 days. So that's the AI component. Now, where is he using blockchain? Well, Figure has a permissioned blockchain, and this is where I think digital assets and distributed ledger technology has the most ability to disrupt. It's not so much the public chains, but these permission chains where you can drive efficiencies into individual businesses. So what he's doing is he's a warehouse lender. So he's lending out this money. He's doing it in the HELOCs market, and he offloads that risk through CLOs, which he had done traditionally. This is where he started. He's gotten all of the major investment banks in the New York area in the United States to buy into Providence. That's his permission blockchain. The native token associated with that is hash. So he has all the major market players in the CLO market. So he is now actually issuing his CLOs on chain. So there's tokenization of these CLOs, and he's trading them off his balance sheet to these investment banks with the blockchain provenance. And he can do that, instantaneous transactions. So that's a company that is pre-IPO. He was going to have a reverse merger with the SPAC. He's decided to go into an IPO process, and that might be one of the next big successes here that you see coming out of the area next year in an IPO.
And what's the name of the company?
Figure Technology.
Figure Technologies. Russell, you want to piggyback on the back of that? Tell us where you see AI today and blockchain today and where you think they'll be in 5 years. And there's an intersection like Michael just described. That'd be great too. And if you give us another 10X,
Sure,
we'll
sure,
love you.
20 now.
20.
I could also tell about some losers too. There's a lot of losers out there as well. So
Yeah. Well, so yeah, I think let me be a little bit more, perhaps not quite as optimistic as Michael. Let me answer your first question, and then we'll go towards some investments. So my crystal ball is as good as anyone else's, so take it with a grain of salt. But there is definitely the evolution that we're seeing in terms of the increased speed of development in AI, I think, has not been seen before. The exponential growth. Now, you can go back and say AI has been around for 40 years, deep tech, etc. But let's just take going forward to the last 2 years and the exponential growth that we're seeing. Now, the question is whether, and we are, as a family office, I'm actually, there's a few projects that I'm trying to incorporate this AI as an investment and AI as a sort of user interface. And what we're trying to do at the moment, fortunately, I went to Anderson Business School, UCLA, and I'm very good friends with the professor who is, I got a thumbs up there.
You got 4 thumbs. That's 4
thumbs up.
degrees.
And a friend of mine is one of the professors in the blockchain AI department at UCLA. He's running the program, and he's been very kind to me to offer us the possibility of doing projects with 3 or 4 PhD students to do these projects. And we are actually trying to use AI, and we're designing the project as we speak right now. So I'm not quite sure what project we're going to give him. We have a few ideas. But the essence is how to use AI, and I think it's just a question of time. It's going to get better. Every version of new AI, and there's many more besides ChatGPT, there's Queries, there's Perplexity, etc. There's more. There's Bard. What we can use it for us, in terms of finding good investments, good funds, and can we do it in a more effective manner? So I think it's going to be a very effective tool. And yes, all of us should be embracing it as a tool. It's not there yet. We haven't been able, because of this many permutations, etc. So it's not quite the finished product, and will take a bit of time. So I think as we, whether it was the internet, and then you could argue whether it was blockchain and now AI, there are some dramatic technologies that come around increasingly more often that I think have tremendous influence on our day-to-day lives, and tremendous, hopefully, tools, etc., that we're going to use. So I think it's going to be more incorporated. Now on the investment side, that's a bit more tricky because of the valuations that we're seeing. We look at a lot of projects. We look at a lot of we look through funds. And I'm also just in full transparency. I am invested in Morgan Creek's Bitcoin fund or blockchain fund, and not all of it went well. And there was an investment, unfortunately, in BlockFi, which I think Michael can talk about, that went to the moon and crashed. And we can get into the details of that. So that affected the returns of the overall fund. So one has to be careful. There are opportunities, but there are risks. So what I see is, for us, we've already put a decent amount, 7 figures or so in the eco space. We will continue to do it. I'm looking at I think that the DeFi will do well. I think Layer 1 would do well. I think, for example, Solange is going to do well. We're seeing that there are opportunities, but what one needs to figure out, and this is not easy, are the tokens that have, or companies that have enough runway for 2 years to do well, and also have the technology, the user interface. Is it a practical, is it a solving a solution? So if you're looking from a chief investment officer or chief information officer for an enterprise, a big 500 companies, I personally don't think they care if it's AI, blockchain, DeFi. The technology doesn't really matter to them. If you can make it cheaper, faster, and more efficient and solve a problem, then that's a good business case. And that is going to create revenue, and that's going to create growth. And that's kind of what we use that as a benchmark. Independent, I've invested in BlockFi, we've invested in AI, we've invested in deep tech through funds as well as companies. And it always goes back to, is this company providing a practical user interface and solving a problem to make it cheaper, faster, and better? And if they are, they're going to get traction. Then you have to see if they're well funded, and then you have to see if that is something that makes sense. So just to end my response, I think it goes to, we are always looking for down to the people and who can execute. I think the trends you can get, but the people who can execute. And that's why we spend so much time getting to know people and doing due diligence on people. So as we go forth, and one of the things that I would suggest, what we've done, if it's higher risk, but you still like it, invest, but make it a smaller investment. Adjust your investments, whether it's an angel investment. I'm looking at a token right now, which I think is very interesting, but I've just started. So since I've just started, I'm not going to recommend it to anyone because I haven't finished it. But
Had some good
the
practical
question,
advice.
yeah, the question is, if you like something, but look at the risk reward ratio and adjust the check to do that. Because if you do not do it, and I was on a panel just the other day, and it was interesting. Someone said, if you wait to find an AI investment with the revenue of $10 million, you're going to miss so many opportunities of these companies. You can't wait necessarily for that, but then you want to do a 100x revenue of valuation, pre-revenue. And so there are, certainly, as Ron said, many 10x possibilities. But as I'll never forget, one of my angel investments, the day I got a 16x, I got a 0, I got a donut. It's part of the process. The methodology was the same. So one day I looked at myself in the mirror, I felt very intelligent and very stupid at the same time, literally within 1 hour of each other. And that's going to continue. The volatility is going to continue. And that is something that we need to be aware as investors. Adjust the check size. Think about that. Make a concentrated portfolio, but look at your risk parameters going forward. And I think that's the most important thing. Play. Make a decision. I want to be invested. Don't sit on the guide on the sidelines, but make sure you do the adjustment, considering the risk reward properly in these investments.
I want Ron to pick up here a little bit.
Sure.
Talk a little bit about his insights on both blockchain and AI. But also, I want you to start talking about areas outside of those two that are
Most
exciting to
important.
you.
On both of these, I think you got to first taste the food before you starting your restaurant.
Absolutely.
Right. So our investment in in AI was, how can I use it to make my business faster, better, and more responsive? And then how big an area am I going to address? And we fell into this actually by accident, where obviously as a finance company, we have governance and risk and compliance. And we also had done quite a bit of work during CCAR on model validation, model testing, model interpretation. The regulators are not going to let AI in a bank until you can actually explain the guardrails. So you just had an AI legislation in Europe. We're talking about the US. So knowing your technology, knowing your models, knowing how you are actually evaluating. So we said, why don't we use AI for knowing your technology? So meaning that we actually created a product called Risk AI.tech, if you go there. And all it is really ultimately using AI to actually help do the 3 lines of defense, which is, take a regulation, translate it to policy, then take the policy and translate it to workflows, and then take that workflow and really do an outcome-based evaluation of it through the lifespan of that. And we looked, there was no tool like that in the marketplace. We couldn't, we had high net worth asset managers coming to us. As a matter of fact, this ended up being, we started with using traditional technology, trying to do that, and said, well, why don't we, every day the requirements were changing, the circumstances were changing. We couldn't really write a code that covers everything. So we said, well, why don't we let AI generate the code as we are evolving? So for us right now, AI, I know a lot of people are trying to do that in the credit world, right? You have to recognize also when the regular CFPB is stuck at your door and saying, what is your model doing? Is it redlining? Is a very big risk. The banks ended up having to go back and defend themselves on a redlining. You can't just use factors, just knowing those is very important. So coming from a regulation, transparency, risk management into this world, you find that technology both is a solution and a problem. And we found that the banks are slow and they couldn't get this stuff done. And they look at people like us to come in and really perfect it. And that's how BlackRock succeeded in integrating all the asset managers under one roof. And hopefully we'll be able to do that on the what we call embedded finance. So embedded finance for us is essentially how do I use technology to be at a place to actually originate, underwrite, and be the best solution on the platform. Visa and MasterCard are nothing but technology, right? That's what they are. So how can I get rid of Visa and MasterCard? And that's what we did with FuturePay. FuturePay is I can easily connect to the merchant and get their customer and lend. I don't need to go, especially with the government now, with the Fed now, I can immediately pay the merchant. They don't need to validate me anymore, right? So FuturePay is disrupting what I consider revolving credit, the same way as you had the student loan market, right? And similar, then we found out the employees needed liquidity between the paychecks. Yeah, in the US, about 50 million people need that, paycheck to paycheck, and not as a lending tool, but really, I work 5 days, give me my 5 days pay, right? So that's our Orbit Space side, which connects employee to employer, and we have an opportunity to provide a very secure cash and collect from the employer without being considered a lender. So those are some of the very simple, and you can use blockchain. Blockchain is a validator. Blockchain is not a mechanism. So you should, I really believe if you formulate your criteria into a blockchain, then you can tell people what does that algorithm do. So the regulator right now is scared of it, but ultimately they will adopt it because that's a good validation tool. On sustainability side, it's a tip of the iceberg right now. Everybody is going to have to measure, validate, measure, report, and validate, and certify their carbon print. If you think we're having trouble accounting cash, think about how we're going to count our sustainability goals. And that is a vast market. Every corporation in the world is going to have that issue. Yeah, go ahead.
I'm gonna now toss it over to Michael. So Ron just named a few things. He went to RegTech, obviously, is one area that he's very interested in. That's sort of built on AI and blockchain, but sort of outside of that realm too. He mentioned embedded finance as well. And he also just spoke about the sustainability. Are there some other areas that you're looking at that you think are very, up and coming?
Sure. Those were very astute observations, Ron. I can tell you, just looking at those verticals, I have specific examples, and then I can go over some others. Okay. So, for example, in sustainability and this whole greenwashing effect that a lot of corporations are going through. So if you're an investment manager and you're advertising an ESG mandate, in Europe, you're mandated to do that. In the States right now, the SEC is looking at stricter rules. But if you're marketing that, you better make sure that 80% of your investments have some type of overlay. So then you've got to look underneath the hood and see the individual companies. Now, some companies greenwash by buying carbon credits or whatever. There's a company out there called Triangle Digital. And what they're doing is they're using AI to take the information surrounding sustainability on a company level, in particular around ag tech, and they're providing that on a public ledger. And so they're now making that available to asset managers. So I can go and look at my portfolio if I'm a private equity fund or whatever, and I can see, okay, you know, I'm looking at their documents, but these companies have to provide reporting to the government. So they're sifting through that through an AI large language model, and they're providing that through, it's on a smart contract. I think it's Ethereum. They're using Ethereum to get it out there. They are also designing, and they have in contract, they have a Bermuda-based digital exchange for carbon credits. And they've now just issued their first digitally native carbon credit security, which they will now be marketing and market through this digital exchange, which is backed by, you know, digital exchanges. The problem is you have to have, there's an inflection point for the participation. You better have at least 85% of the participants in whatever market is be part of that, right? So they're looking at all the market makers for these carbon credits, the major players out there, and they're getting them to be participating in that. That's the only way an exchange works. You can have 24/7 global access, but if you don't have the participants, it's not going to work. So that's a lot of what this promise of securitization of real estate or whatever. You still need liquidity, you know. So that's an interesting play on that.
Marty, do you have a question?
Oh, sorry.
I do.
Yes.
There you go.
There's about 10 minutes, by the way. So
I got.
I'm sure you guys have read 0 to 1, Peter Thiel's book.
Yep.
0 to 1, where he posits that you don't want to build the next best iteration of something. Instead, you want to innovate beyond what people think. Like, so his consideration is having leapfrog technology. So what's the great opportunity in fintech? Is it making the next better payment system, or is it doing something that's fully greenfield, et cetera? So my example is that all these guys come from McKinsey consulting backgrounds, and McKinsey said they were going to sell 800,000 cell phones by the year 2000.
Yeah.
Right, they were way off, right? Because they thought everybody had to go through the transition of going to getting wired and then getting to find out how phones worked, and then they go to cell phones, right? And instead, the whole world adopted cell phones and bypassed telephone lines. So, any thoughts you guys have on that?
No, I think the infrastructure on connecting data lakes and then connecting AI BI on top of that, you need a very sophisticated Web 2 framework, meaning that you can't just come in and say, you can't take, NFT of something, you're buying the same thing, are going to have to go ahead and read the fine print and find out what is it I'm investing in. Can you get the data validated and transparently so the due diligence for us, everybody in this room knows, how can I make sure that this damn data is correct? Mm-hmm. Who has validated it? And if somebody validated it, then all of us can use it.
Right. Yeah, there's an issue around data lakes, though, which is how do you value a data lake? Most people don't want to sell their data.
No, your own data. I'm saying for private asset securitization, I assure you, in about 10 years from now, we're all going to be a lot more comfortable investing in private assets because you know what you're getting. But you're not going to buy a corporation that some auditor put in the numbers, and you don't have. You're looking at, EdTech. You're seeing that the quality of the data that you have in public companies and the opinions you're getting in audits are very, very weak, to say the least. But if I give you a building and give you every lease in there, give you and actually abstract every single lease, and then take that lease data and take the information you're getting, payments that are coming through, and then put that in a private security, I can then make this building extremely easily marketable, and somebody can put a price on it because I know when is the lease term is over. Is everybody a 10-year lease? Everybody's talking about wall of think of the wall of leases coming due as opposed to wall of debt coming due, right? So you got 3 layers of information, And anybody in real estate knows that a lot of time gets spent on validating data. Validating, I'm going to invest in this property. If I put that on a blockchain for you, but I have to have a Web 2 because I have to have a situation where I'm getting the data from somebody that is, so you can't just go straight into blockchain without having your Web 2. The Web 2 to Web 3 is more of the validation and who validated and give you a token that this was validated by X, right? It's more of that angle. And you also have to recognize blockchain is very slow today. You have to have anything is built now on blockchain have to be rewritten because you need sharding, you need, essentially it's going to grind down if you actually go in depth. So that's why we're a little bit hesitant to pick a blockchain because there are about hundreds of L0s and L1s that are, we don't know who's going to end up having the right, Microsoft. Sure.
So gentlemen, I want to add a couple of comments that.
Glad you did.
Yeah, please.
This is not obviously investment advice, but since we're sort of talking about some ideas, I thought I'd give that. So, one of the things, what we try and do is look at what's worked previously and then try and find the next reincarnation, next evolution or next idea with that. So if I look at we did an analysis. So there were 3 tokens that sort of have done well. And just these examples, and I'm going to tell you what led us to the next token. So you may or may not know Lido. Lido was a liquid staking solution for Ethereum, for Solana and Polygon. Since its seed investments in January 2021, it's up 492 times. Another one is Avalanche, which may be a bit better known. It's a leading blockchain protocol, offers scalability, and that has gone up 300 times since its Series A in November 2020. And then Damian is more of a blockchain infrastructure provider. It offers nodes management and staking, and that's up 95 times since June 2020. So again, these are small bets that we're making. So what do we say? What's next? And so we looked at something similar to Lido. There's now one called Layer, which is creating a new market for liquid staking that didn't exist before. So we're thinking that's the next evolution. Similar to Avalanche, LeFi is building a core of technical infrastructure that I think is missing in the Web3 today. So we believe that will be a good investment. The other thing that we've done, similar to Damian, is a token called Evitus, and we think that also is it a possibility. Now, there's a lot of risk in taking these smaller bets, and we make smaller bets by doing that. So I think Ron is very good at talking about and connecting the dots. We try to connect the dots and see, I guess, as Wayne Gretzky says, where's the puck going, not where it is, right? I'm not
Exactly.
sure, sometimes we've missed the puck, to be honest. So take it all with a grain of salt. But I think the trends are fairly obvious that you can get to with reading, and then you try and think, well, where we're going to be in the next couple of years. Now, the other thing that we've done as a family office, we also know our limitations. This is a sleeve of all the investors. We do a lot of private investments. We invest in AI, we invest in deep tech, we've invested in blockchain, we've invested in earlier stage tokens and other non-AI blockchain. So that's, of our venture capital, maybe 5% of our portfolio. So we think it's a very good, and we've done 4 or 5 investments with managers. Going back, I think our first investment was 5 years ago. And someone getting into the space, I would say you start that way. You start with a fund of fund, which we did. We did 2 funds of fund. Then we found managers from that we really liked. Then we work with these managers to do co-investments in equity rounds, and then work with the managers to do co-investments in tokens. So we've been able to, and we'll continue. I think I know 2% and don't know 98% of what's going on. And that's a way for us as a family office to be able to use the infrastructure and also use the expertise of other people who have tokens on this 24/7. And that's important to find people who have very deep knowledge, 5, 6, 7 years. And that is the only thing that they're really doing 24/7. because they're going to help you with the research, and they're going to help you be more informed to then make your own decisions. So that's one way that we go at this whole ecosystem at the moment.
Terrific. I want to go back, and BlockFi was mentioned a couple times, first by Russell and Michael also. So do you want to talk a little bit about why you like that deal and what happened? And let's try this, do this kind of quickly because Marty's got out the long cane here.
So Russell and I were both involved with BlockFi, and I think Russell, you were involved through the investment that Morgan Creek made. We were a seed investor in BlockFi. So BlockFi was a company that was developed to help people get onto Web 3.0. It's a CeFi protocol. So it's basically, it's traditional finance. Literally, they were a bank. And they ran into regulatory problems where they weren't registered as a bank. But really where they got the biggest problem was their risk book. They didn't manage their risk properly. And they were advertising that you could lend you could deposit your crypto with them, whether it was Bitcoin or Ether or any of the larger ones, or even stable coins, and they would provide you a return, an interest rate on that. Now, a lot of those returns, they were getting through the DeFi protocols themselves. So, the blockchain itself, Bitcoin is proof of work, but all of the smart contracts that have come around are proof of stake. And that's just another way where not all of the nodes have to verify a specific algorithm. You can do a round robin. And so the way that you prove that you're not cheating is you're putting up money. Right. And so you're getting a return on, you can stake your tokens into these smart contracts, these proof of stake protocols. That's on chain. That's DeFi. That did not break. But what was happening was the collateral, and that's all over collateralized, right? So that's rules based. When you get called, your margin call, boom, you got to put up your collateral, which is the actual underlying crypto. BlockFi started lending, and they started using, they first advertised that they were going to use just like Bitcoin, the actual crypto as the collateral, but they started to accept things such as GBTC, which is Grayscale's grantor trust. Now, that all was fine and dandy when GBTC was trading at a premium. It's a grantor trust in the market, but when it started trading at a discount, that was sort of the first crack in the armor. And then when FTX happened, it just blew up. Their lending book fell apart, and so they were under collateralized. All of the DeFi protocols, they had to sell. They had to get rid of all their stuff to shore up their DeFi protocol investments, right? Because they had to pay that, and that's when the house of cards fell apart. That was probably, I'd say, the primary reason that happened so quickly. And if you look, Zach Prince and Flory Marquez. Flory Marquez was the head of risk at one point. They're young. These are young professionals that thought they knew. We know a better world, right?
Yeah.
We know how to do it better.
So let me actually comment on this, because there's a good telltale sign, right? Majority of people who go into fintech, they're straight out of either computer science, or they have never lived a day in finance. But they find themselves going into finance world by all the major essentially hype and then collapses is because they made the exact same type of risk that we talked about, leverage, over collateral that was not valued properly, or there was actually a loophole. Somebody used it, even though they were not permitting to take your collateral and lend it somewhere else. And these are very simple, detectable issues. If you're talking to a fintech company and they don't have enough finnies, walk, because you need to have governance. You need to have, right? If they don't understand the banking regulation, they're going to get caught. They're going to get caught. It takes X number of years to get that experience.
There's been a big maturity in the digital asset space. I mean, 6 years ago, when the first Bitcoin events, it was all stick it to the man, and we know better. We know this is the new world, and the adults have joined the party, and that's what you really have to be careful about. The kind of investments I like in digital assets are not the greenfield investments. So Marty just mentioned you need to go greenfield. I like companies and enterprises where you can find a pain point that we talked about.
Yeah,
Can
yeah,
you
yeah.
solve
The
that
pain point.
pain point? Whether it's by distributed ledger technology, AI, machine learning, if you can drive efficiencies, because you're eliminating one big risk already, right? Which is the enterprise risk, right? You got the technology risk, right? And the execution risk, but you've already got it. It's not totally greenfield. When you just have a brand new entity and a brand new technology, and especially with brand new, executives, that's
legislation that you don't know because the regulators
yeah.
are effectively regulating by examination. They come in, their rules are not there, and then all of a sudden they start asking questions. They walk into your offices, and these guys ultimately ended up like Binance, selling.
Why do you think lawyers write the rules?
To be violated?
And the other thing is the incumbents are very powerful.
Powerful, yeah.
Don't
Yeah.
underestimate the power of the incumbents.
Russell, I want to give you a final word here because Marty has now got out the cane and he is yanking. So if you would do us the favor, just close us out here and then that'll be terrific.
Happy to do so. Unfortunately, I'm in Miami, so Marty's cane can't quite reach me quite yet. But
I wouldn't be so sure. There might be a gator sneaking up on
He
you.
has the power to.
He can cut you off too.
That's true. So I think we have identified just to this conversation, enjoyable conversation. Obviously, there's a lot of opportunities, a lot of potential investment, very high returns, more than the traditional other verticals that we've all know about. But I think we've also identified whether it's through the fact that the regulation is not complete, and the regulation varies very much between different countries. So we've invested in a blockchain fund and a blockchain in Singapore, which is, I think, one of the leading places, fairly clear, user-friendly. I would say Zurich is quite good and transparent, and the US is lagging behind. So take that, when I look at investments, I look at this as a risk investing in US companies, because it seems that the SEC is playing catch up. And as Michael said, there's a lot of transient, very powerful players of traditional banks and others that are against this. But at the same time, I don't want to pick on JP Morgan, but obviously we know that they're investing billions of dollars in this at the same time speaking badly about it. So, do they want to centralize it? So what does this mean? What does this mean? I hope Jamie Dimon doesn't come out and get me now for that comment. But basically, and I think everyone has to be wary of the increased volatility that's in this sector, and therefore adjust appropriately. Whether we like to invest in the infrastructure enterprise solutions because there's real clients on the other side and real money. I think that over the next 10 years we're going to have some spectacular success stories, and unfortunately we'll continue to have the FTXs of the world happen. It seems like there's not the first one, it's not going to be the last one. It's just unfortunately in nature of, I think, of this business and what type of people, young people that have been attracted to this. And so there's going to always be increased volatility and returns in this sector. So, be wary and adjust going forward as you make investments.
Yeah, I think to sum it all up, it's another investment opportunity and some infrastructure within fintech, right? Within the finance area, and you have to approach it. You heard, what's the pain point, right? That goes back eons. That's not something new, right? So it's applying all those same things you would do to real estate to what you would do within this area, particularly this fintech area. So, gentlemen, you did a fantastic job.